Welcome. In this video, we're going to be talking about Roth conversions. Now, Roth conversions are one of the topics that come up typically towards the end of the year. You'll probably hear it shouted from financial advisors like myself because they can be really one of the most powerful wealth building actions you can take if you fit into the right circumstances. So it's important to note, why don't you hear about Roth conversions more frequently? So no disrespect to my peers in the accountant profession, but unfortunately, a lot of times accountants aren't going to bring Roth conversions to your attention because primarily their job is to focus on reducing taxes every single year. In a difference though, what the Roth conversion is doing is it's actually sacrificing paying taxes today because of the huge upside of ultimately avoiding taxes tomorrow. And so I'm going to go through the example and showcase how this works, why it's so important, and really how you can be keeping a lot of money in your pocket if this is applicable to you. And really this will be something that you want to connect with your financial advisor and your accountant on, collaborate. That's really why having that full team is so important. The last couple of weeks I've been on the phone nonstop with my clients' accountants, reviewing these types of actions and making sure that if they do make sense for our clients, that we're able to put them in motion before year end. So as I typically do, we'll show an example to really drive home the point of just how powerful the Roth conversion can be. All right, so pulling up here, this is the tax brackets for 2020. In this case, I did married filing jointly, and just pulling this directly from taxbrackets.org. They do a really good job of including the federal tax as well as any applicable state. I'm here in San Diego, so we have the California state tax pulled in so that we can highlight that as well. Now, what the Roth conversion is doing, I think first we'll just take a step back and explain a key difference between a traditional IRA and a Roth IRA. And with the traditional IRA, you've typically received some sort of tax benefit up front. And you are then going to be deferring taxes until ultimately later when you pull money out of the account where you'll pay tax on those distributions. Now this makes a ton of sense if you anticipate being in a lower tax bracket later. So typically a lot of people think, okay, I'm going to be retiring, my income will drop, and I'll pay the taxes at that point, when I'm in that lower tax bracket. Now for many people that's a great strategy, it makes a lot of sense. But there's going to be a number of you, specifically if you're earlier in your career, that may be in a lower tax bracket now than you think you'll be in later. Whether that's, again, early stage of your career, or maybe you're just really ambitious and driven and you're having multiple income streams that you're building right now, and you really don't foresee the tax brackets ever being lower for you. Maybe you'd say, hey, I'd rather actually pay that tax now and get all tax-free growth later. And if you fit into that camp, the Roth conversion can be an extremely powerful move. I'm going to showcase why that can be so important. So the way our tax brackets work, we have marginal brackets and a progressive tax rate. So meaning as your income goes up, you pay more in taxes. And you can see, just broke out the math here very easily. So if you hit the caps on each of these brackets, this is ultimately in column E here, the amount that you would pay after fully capping out those brackets. So for example, someone making anywhere in 175,000, they're paying all of these three tax rates, which combined up is about 29,000, plus then 24% of the, in this case, $4,000 that spills into the 24% bracket. So that's really an important first starting point. A lot of people tend to think, oh, I made $200,000. That means I was at the 24% tax rate, which is your marginal tax rate. But when you think about your effective tax rate, which is like all of the dollars you actually ended up owing, it's going to be a lot less than 24 because it's really the break point of all of these different tax rates combined. So that's an important starting point. And the reason that becomes important is because we want to use that framework of basically filling up your bracket potentially as a way of ultimately maximizing this Roth conversion strategy. And there's a couple of key things that you'll want to be aware of in order to make sure that you implement the strategy effectively. So the first thing is, when you're looking at the Roth conversion, I pulled this example here and I said, okay, let's assume that we have someone who, again, a joint married filing couple, and they've made $180,000. So let's just say they've both made $90,000 this year. They will be falling in, you can see, into this 24% bracket. So they're making somewhere between this 171 and 326. So when we talk about filling up the bracket, what we mean is, well, how much money can they basically add to their income before they cap out this 24% bracket? And in this case, I just simply took 326,600 minus 180 means they have $146,600 of wiggle room, if you will, to cap out the bracket. And what you could then do is, let's say they have, typically you're going to be conservative because you don't want to really jump into the next bracket. So meaning like you wouldn't want to spill over into this 32% bracket. So oftentimes what people would do is in this case, they'd say, okay, well, maybe we're going to convert 140,000 just to give ourselves a little bit of a cushion. And typically what that's coming from is something like a SEP IRA, a rollover IRA, a traditional IRA that you've taken all deductions on. So they're all any types of accounts that have a significant amount of pre-tax contributions within them, contributions and earnings. And so you're looking at those accounts and you're saying, okay, is there an opportunity where we can now convert those, pay the tax on them now, and move them over into this Roth bucket? All right, in this example, let's just then say they have a $100,000, let's just say it's a SEP IRA to make it easy. Well, what they could do then is say, you know what, we're gonna convert that $100,000, we're gonna pay tax on it now. And when I say pay tax on it now, typically that means come April 15th when they're actually filing their taxes, their income is now gonna get jumped up. So instead of it saying that they had $180,000 of income, we're actually gonna now add the conversion to it, and they're gonna have $280,000 of income. So what did that mean to their taxes, right? Because initially they were probably withholding from their paychecks to appropriately account for this $180,000. They had not withheld anything for that other $100,000. And so here's where things get interesting, and this can often be, if you don't plan properly, a really bad surprise for anyone who utilizes a strategy, because what you just had now is $100,000 times, in this case, they're in that 24% bracket here. Sorry, that's easy math. Really need to do the multiplication there. But so $24,000 of additional taxes. And you are bumping up the taxes now because, again, you don't want to pay them later. But this is really important because you now have to make sure that you have cash available on hand in order to pay those taxes when they come due in April. You really don't want that to be a surprise. So typically, if I'm ever having anyone convert, we're plugging money aside, normally in some sort of high yield savings account, or we're making sure that there's a far and away large enough investment account that they're able to pull that without having to worry about any sort of stock market pullback. But we want to make sure there's a very safe and secure amount available to pay those taxes come April, and that there's no surprises. That's the biggest thing there. Because now that tax burden will be covered and they won't have any worries. And what we've now been able to do is move that $100,000 so it will now grow in a Roth account completely tax-free. And the reason for that is any growth now moving forward, we're assuming in this example, this is someone who's on a high trajectory, so they don't foresee that the 24% bracket will be their highest. They think they're gonna be in 32, 35, 37% or more, depending on what happens with the future tax code. They think they're gonna be in a higher bracket later. So they'd rather pay that 24% now and get all completely tax-free growth. That way, when they're in one of those higher brackets later, they're gonna take those distributions, and instead of getting hit really hard at that higher rate, they've already paid those taxes, so now it's gonna be completely tax-free. So, just to give you an example, if this is someone, let's, just say they're in their 30s, and we have, just display the math here on how powerful this can be. We've moved it over into a Roth account. Just say we're gonna keep that there for about 30 more years. We're not even gonna add to it in this case. We'll just show what that looks like without making any adjustments. And we are gonna start with that $100,000. So after 30 years, reasonable 8% growth rate, and even no additions, that person is now sitting on $1 million of what otherwise would have been getting hit at higher rates as you started pulling that out. In this case, it's completely tax-free because you've already converted it over to Roth. So you can see why this is so powerful. Now, I mentioned the state tax It's the same type of math, of course. We want to make sure that we're also withholding for the state taxes. So in this case, it's going to be a combination of the federal plus, in this example, that $100,000, because they're in this bracket here, is also going to be subject to that 9.3% rate. So you'd also have $9,300 subject to California state tax in this example, just to drive home the point. So you can see you're paying up front, which can be a burden, so you want to make sure that the math works, that you have the cash on hand, and that you really foresee that likely you're going to be in that higher bracket later. But if you are and you think that that's a high probability scenario, clearly you can see how this can be extremely beneficial and why you have advisors like myself, screaming it on social media of why this can be such a powerful action to take advantage of. So I hope you found this information helpful. Again, this is Roth Conversions. If you did, I always would appreciate it. It's a new channel trying to grow it. Please go ahead and hit that like button. If you are interested in this type of information, I'd encourage you to go a step further and subscribe so you can get future updates on these types of videos. Thanks again. I'm sure I'll talk to you again soon.